Hello, everyone. Thank you so much for joining us again for another weekly wrap up. And we're going to also do some market volatility commentary today as well. My name is Jeremy Kronemeyer. I'm Operations Manager for Wickham Financial Group, and I have Graham Wickham here, President and CEO of Wickham Financial and Insurance Services. Graham, what happened in the markets last week?
Yeah, thank you, Jeremy. And thanks for our listeners jumping on the call. And I know it's been a lot of volatility and a lot of concern and a lot of questions. So let's get into wrapping up last week, and we can kind of chat about maybe some thoughts and considerations, going forward with what's been going on. But basically saw U.S. equity indices fall for the third straight week due to some trade and geopolitical tensions. Really starting to boil to the top is some of this economic concern, stagflation, recession. You hear those terms being brought up. So we saw the S&P and the Nasdaq both fall about 3%. The Russell Small Cap 2000 fell about 4%. So what were the ones that fell the most in terms of sectors? We saw financials, consumer discretionary were hit the hardest, then tech. What actually held up and outperformed, at least value outperformed growth, but that was led by consumer staples and healthcare. So if we look at GDP estimates, the Atlanta Fed came out and revised their growth estimates from a positive 2.3% to a negative 2.8%, and then later came out and adjusted that to be a little less worse in their projection to only 2.4%. Now, tariffs. White House is exempting Canada and Mexico and some of their goods from some new tariffs. But keep in mind, that is super duper fluid. I think we all know it by now. If you just turn on the news, it seems right now it's nothing more than a little tit for tat. We'll see how they affect us. But if we look at Treasury yields and the dollar, U.S. Treasury yields ended higher and the U.S. dollar hit a 4-month low. U.S. data that came out, we saw non-farm payrolls increase about 151,000, slightly below estimates. The unemployment rate, that rose up to about 4.1%. Now that is still really contained. That is not flying off the handle right now in terms of running up. So that's still very contained, still considered pretty close to full employment. The underemployment rate, that increased to about 8%, and the manufacturing sector was steady. And then we saw some services growth that did edge up a little bit. Now going overseas in the European stocks, we did see a surge in those after Germany proposed some pretty significant government spending shifts. I think they'll ramp up their defense spending. European central banks cut interest rates or lower their rate to about 2.5%. And Germany's fiscal policy did shift to a surge with the Bund yield. And then if we look at OPEC, they proceeded with some oil output increases, and now that lowered crude by about 3.5%. China's still struggling a bit with their imports and exports. They slowed pretty significantly, and that set their GDP growth rate to around 5%. That's their target for 2025. Just still seeing some economic challenges over there to try to get past. And then kind of looking into this week, I think it's going to all be geopolitical concerns, tariff talk, the tit for tat for that. So be prepared and mindful. I know we'll chat about it just a little bit more in a second. But U.S. events, we'll be looking at some, from an economic standpoint, looking at some February inflation data coming out, some preliminary consumer sentiment numbers for March. We'll look at some CPI numbers. And keep in mind, we want to keep that down. We don't want that hot. That could spook the market a bit more. And the Fed, I think, and at least the perception of the Fed's role this year might be coming back on in terms of, at least from an anticipation, if we are going to see some slower economic growth, maybe the Fed steps in, kind of lowers interest rates a bit. That is still to be realized. So we don't want to put the cart too much before the horse here. Then Friday, we're looking at consumer sentiment numbers, some JOLT numbers, producer price index. And then we want to see how the auction goes for the 10 and 30-year treasuries. Jeremy?
Thanks, Graham. I had a question for you. So with all the tariff talks going on right now and the market volatility that's really happened in the last couple of weeks, what do you think people should be thinking about with their portfolios and kind of going forward with all this stuff going on right now?
Yeah, absolutely. And I know it's concerning, it's fearful. You don't always know when it's tit for tat and all this is going on. And we haven't really had this kind of kerfuffle, if you might, in a while. And I think that's putting some growth fears into the market. I think we've commented in the past, it's, we are in a reasonably strong economy. We might have periods of weakness that are short term. We have a reasonably good consumer that is still willing to spend, even though they're probably going to be a little more mindful of where with all this conversations going back with tariffs and so on and so forth. But keep in mind, we got the Fed there, we got a reasonably good economy, reasonably good consumer, and the earnings are still in place. But there is a bit of a growth fear because of the tariff and the potential psychological pullback by companies, consumers with all this conversation going on. And that's causing that volatility that we said you probably had to expect coming in to the first quarter of this year. And then, boy, we're seeing it. So we got the Dow, I think, is down roughly around 6% or so. We got the Nasdaq off, Nasdaq's off about 12 and change. And I think the S&P is approaching that 10%, that official correction, 10% or more would be our correction range. So, will the market stop at that 10% or close to it? Probably not right on, but we are testing and kind of pushing past a little bit these moving averages, which if you're a trader, if you're mindful of technicals, those are kind of important markers for the market in terms of where it might set a base and build off or if it might kind of continue to move past on the downside. So all in all, let me get to the point here. Don't panic. I mean, I think that's key. Don't panic. If you got a balanced portfolio, you've done your homework at the beginning, you're making some adjustments, maybe still on some things that maybe have done extremely well in your account, it's still okay to take a little bit of profits and make some small adjustments. But I think the biggest thing is we want you balanced. We don't want you panicking. This too shall pass, but it's going to be the talk of the tape for a while. I wish I could say it wasn't, but we know with this administration and what they're trying to do, they like to have these type of conversations, which puts a little bit of fear and panic in the markets.
Gotcha.
Yep.
Well, Graham, I know that you had you like to talk about that oscillator. Did you want to go into that a little bit here?
Yeah, why don't you bring it up? I think it's kind of interesting as we're always trying to consider where are some timely points to add new money to positions in the market. And here we're just looking at what's called a short-term oscillator of the S&P. And again, it's not a flag that's waved, but it gives us hints and clues. Maybe in the very short run, is the market overbought or oversold? And I don't think there's an argument here. In the very short run, we're probably pretty oversold. So we wouldn't be surprised any reversal in the tariff talk and some of the concerns that might be bubbling to the top of growth concerns. If they come down in a positive way, we think this market probably is due for a pretty good bounce. A sustainable rally to new highs, we probably think that's a little bit on hold until we can get some consistency in rhetoric with the geopolitical conversations, tariff talk, growth concerns, all that. But we do think when you see this oscillator kind of dipping down and it's down about 4.92%, down in that range below in that green area, that usually signals a short-term buy point. When it's trading up in that red area, that indicates that we might be a bit oversold. So new money can make sense if you're starting some new positions. Start legging into it a little bit. Start adding a little bit over time as we continue to see some weakness in this market.
Gotcha. Well, Graham, we always appreciate the information and expertise, and thank you to our listeners for jumping on the call with us today, and we look forward to seeing you next week.
Take care.